Our requirements will continue to increase for industrial if we like it or not. Industrial is a really interesting one because it's been the golden child for, say, like the last 5-6 years.
Yeah.
Kind of that old daggy industrial. I think there's opportunity in that. So retail is definitely here to stay. It just looks different. The experience is really, really important. It's just promoting people to go there and spend more time hanging out as a family or in their community and then doing those kind of incidental purchases. The thing with childcare to understand is it's very, very location sensitive, but look, it's still an asset class of attraction. Also, we kind of call it a set and forget assets. So we're way down on where we have been in the past. We've been kind of kicking the can down the road, if you like, to some extent. People have been reluctant to move because they're just waiting and seeing what's going to happen with interest rates, what's going to happen with this, and this might kind of spur on something else.
So in today's episode, we catch up with Vanessa Rader, the head of research at Ray White Commercial. It's great to be able to have a guest on our podcast with so much knowledge on the commercial property data space. In today's episode, we go through the shuffling of sectors, what we're seeing from places like retail, industrial, commercial, what's the lay of the land, what's happening across Australian commercial property at a macro level in these key industries. So let's jump into it, get our dose of data from Vanessa at Ray White Commercial. Vanessa, thank you for joining the show.
Thank you. It's great to be here.
Awesome. Well, it's been great to look into some of your research, specifically the sector shuffles and what to expect for commercial property the years ahead and what the transactions have really shown on the data. I'd love to talk about the world of retail, right? Now, when it comes to retail, if I'm a private investor, I'm looking at retail and thinking, wow, it's been a bit shaky in some areas. We've got the COVID impacts as well from years ago. How are you looking at that right now? Like, what is that showing ahead from the signs and signals you've been seeing?
Yeah, retail is actually the asset class I've been kind of the most excited about for the last 18 months. It's a really interesting that you mentioned that COVID period. Everyone kind of thought, okay, that's the end of retail. Retail's dead. Everyone's doing everything online. They're not going to go into shops anymore. They're worried about, touching things. But very soon we kind of realised we actually do like to go out and spend money for various different things. So I think that over that time, since that period, we haven't been building any new retail. So if you think about it, our population has grown considerably. So this is not just a Sydney or Melbourne issue or Queensland. Across the board, we've grown population, but we're not building new retail centres. So our space per capita is decreasing and we do like spending money and going out. Maybe what we're doing when we go out is slightly different. It's not kind of clothing and soft goods anymore. We might happily buy that stuff online. But services, getting your nails done, getting your hair done, going and doing your grocery shopping or your fruit shops and those sort of specialty food options, go get a coffee. So that's really seen a rebound in retail. So retail is definitely here to stay. It just looks different is probably the best way to describe it.
Yeah.
It's a really good point because it costs a fortune to build retail space as well. And I think, the population's increasing significantly. By 2032, I think I read we need 2 million square metres of new retail space to keep up with current demand. So
let's just say, let's assume that online retail does continue to kind of trek upwards. It did kind of stay a bit stable for a little while, but in more recent times it has kind of grown a little bit. There is that kind of Temu effect, the Shein effect as well. People are buying stuff online that way as well. But look, even if you assume that it continues to grow a little bit at a time, it's not going to overtake retail. People are still going to go in and want to touch their pears or their oranges and things like that. Not everybody, but most people do.
Yeah.
They like to go and have a coffee, go have something to eat. Like I said, it will just be different. And you can't cut your hair at home. Like we all saw during COVID, you can't cut your hair at home. No. So you need to go out and do those sort of
Unless
things.
you're like 10-year-old Arjun, when my mum would put the bowl on top and just go around the bowl and just be like, hey, we call that the mushroom cut. When it comes to retail, it's such a good point. You talk about like that coffee. Like I think it's like that experiences economy has also been really picking up over the last few years. I've never had more moments where I've seen, friends, family or myself go, oh, let's take the kids out here or let's go for a coffee here. I mean, I used to not go, as a parent as well, I used to not really care about the shopping malls back in the day, but now with the kids, I'm like, yeah, let's go.
Do they have a play area? Is there something for them to do there?
Absolutely. And you trip past stores.
Yes.
You think, oh, I need that tie for
Yeah.
this, or I need that jacket for this. And I'm not ordering my suit jackets off the internet.
Yeah.
Like, that's another thing, right?
Yeah, for sure.
Yeah.
That's because that's a quasi services and it comes into the retail clothing and soft goods. So even clothing and soft goods, they're not going. If you look at our major shopping centres, those brands that we all know have been around for a long time, they are all still exist in those centres. They might be a smaller footprint. They may not like have every single item in their range, and they do tend to kind of push people to do things online, but you can go into store and try things on. And even that's moved away from the CBD. A lot of these kind of brands are no longer in the CBD. They kind of back to suburban malls because people are visiting their suburban malls more now. And it's funny you mentioned the whole experience thing, because I've written a piece on that not too long ago as well. And like the big centres, so it's not just like going there and having the cinemas anymore and like a dodgy kind of couple of food options. It's about having something where people can go and they can hang out and spend a lot of time. So if it increases that dwell time, there's more chance that people are going to go and walk past and get a tie, or they're going to get something else, get something to eat, something to take home for later. Go to the grocery store, pick up those couple of things. So the experience is really, really important. And it's not just, like I said, cinema. So it could be playthings for the kids. It could be e-gaming. We see rock climbing. There's such a vast range of different things that are popping up into centres now. It's an interesting one to continue to see, and that's just promoting people to go there and spend more time hanging out as a family or in their community, and then doing those kind of incidental purchases.
If you're a private investor, if you're a syndicate, would you say retail would be something definitely to look at the moment?
Well, retail,
from an investment perspective?
Yeah, well, retail, if you look at returns, have actually been outperforming the other asset classes in more recent times. But in fairness, it's done it tough for like prior to COVID. Like already that e-commerce kind of commentary was happening pre-COVID.
Yeah.
Yes, like that price point, perhaps like neighbourhood centres. If you think of your local sort of shops, like a supermarket and specialties, it's usually food and services. They're doing really well. I'm not sure if you go to, you know, people like to drive in, park their car, go and, pick up what they need to pick up, but still have a coffee or meet a friend or do something. So those sort of centres may be price point attractive. When it comes to strip retailing, so your traditional high streets, they're still really attractive assets as well. However, tenancy mix is really important, making sure you get a tenant which can be there's a higher risk associated with that, so you'll be looking at a return in line with that increased risk, because there is usually a bit of turnover when it comes to that. But look, there is retail offerings at a whole range of price points from those kind of smaller strip shops through to kind of the super large centres or the large format type retail, which used to be called bulky goods, kind of like your big homemaker centres. So there's lots of different types of retail. But yeah, certainly one that I think is here to stay. And just on that shopping centre piece too, if you're a larger group, a syndicate, these centres are usually really well placed in major locations, probably transport already built in a train line, bus, something like that, large parcels of land. Is there opportunity further down the track for like mixed use development? Still have this retail there, but there could be other opportunities because they're usually really prime sites and large footprints as well.
Yeah, like a childcare centre.
Well, we're already seeing a lot of childcare centres going into retail because during a lot of those kind of tenants moving out during COVID, we did see childcare kind of backfill some of that space, and it makes sense. You can park, drop your kids off, pick up what you need from the grocery store, get a coffee, then off you go. There's been a lot of creative things going into shopping centres. There's one near me actually that a library has actually, so it's a real community centre, a library has moved into it. It's actually really cool. They have podcast studios and they have all these things to really kind of bring people in, which is a bit weird for a library. But it's it's just another example of an experience that they have inbuilt within that kind of local centre. And it's actually a really kind of cool place. And I have never seen a library so full and happening.
That's very creative as well. And council would be leasing out that library, 100%. So strong lease covenant.
Yeah, for sure.
Yeah.
Loving the show and keen to invest? Well, book your free discovery call and we'll actually walk you through how to build a high growth portfolio without all the guesswork. Just jump onto the link in the show notes or visit investorkit.com.au to book your discovery call. And now let's get back into the show. Well, when it comes to the topic of childcare, it did see a bit of a transactional decline recently. And, you know, most investors would look at that and firstly be like, wait, I thought childcare was a great safe bet. And I thought maybe it's essential services. What's changed?
just because there's transaction decline doesn't mean that the asset class is doing poorly. It's a lot of people, they're tightly held assets. Like if you've got a good childcare centre and you're getting a good return, there's not a whole lot of incentive for you to kind of sell that asset. So there's only so many that can transact at any given time. What we have probably seen is childcare is underpinned by the government and all the rebates and things that are on offer, which is great. So a lot of people that are investing, they like the security in terms of the income stream. Also, we kind of call it a set and forget asset. So an asset that you can just, you've got a lease and you know that they're going to look after the property. It has a certain standard it needs to be kept to, and the tenant will do all the heavy lifting in regards to that. Also, no land tax here in New South Wales, in most states, to be honest, when it comes to childcare. So, look, I think the thing with childcare to understand is it's very, very location sensitive. While we have population growth, it's not necessarily population growth that has children or population growth that has children that will utilise childcare. If you look at a lot of migrants coming here, well, firstly, they don't get a lot of those kind of subsidies and things on offer, but they may come with extended family, and it's in their culture to look after their kids at home and have, grandma, grandpa, something like that, rather than necessarily putting them into childcare.
That's us for sure.
Well, I never, my kids never went to childcare.
Yeah.
We always just kind of did it within our family structure sort of thing. So different things for different people, and as the cost of living kind of issues increase, probably we'll see more people go into childcare. But it's very location sensitive. Look at the new supply in the market, but look, it's still an asset class of attraction. Labour is a real big issue, I suppose. With that, the government's doing a lot to really kind of do a lot of regulation, making sure that we get some really good quality labour into that space with kind of training and stuff in that regard. So look, it's still a good one. Some of those development sites that you probably see hovering around, there's a lot of kind of DA
subject to this, and then come and have a look
but there was DAs that got done kind of during that COVID period because you could do one on a residential.
True.
And unless they're really good quality spots, and they're expensive to build, so just be kind of cautious of the kind of development stock stuff. Just make sure you look at it carefully. But still an attractive investment.
When I'm on the ground looking at the market and looking at listings, I'm seeing hundreds and hundreds of childcares everywhere. So I think, going back to your point, just making sure you're checking the supply, making sure you're checking the data, get the demographic data, population growth.
Because a lot of people think that, this is great, this is a great location, there's so many kids here, but if there's another one down the road, across the road, or another one, then it very quickly, it's not a viable thing. Also, in the past, large centres were what was attractive, these really big centres, but now, it's really hard to staff those really big centres. So maybe it's kind of the smaller that you're going to keep occupancy high is the way to go. So there's lots of different ways to look at it, but yeah. Like anything commercial, your due diligence is super important.
Yeah, I think it's one of those things you got to look at from a business level and asset level, right? I mean, we obviously also look at the macro trends. We talk about this just at lunch earlier today, how the birth rate declining, but then to your point, there's an opposing data set, which is cost of living's increasing, so both parents needing to make sure there's that working function. And so I can see just looking at it macro, coming down to the supply levels, coming down to the local level. And as you said, just because transaction volumes have declined, if it's so tightly held, there's a reason for that. Chris, I know we do a lot of industrial purchases at InvestorKit. When it comes to industrial properties, I'd love to understand, transaction numbers are down a little bit. We just spoke about retail before. What does this say about where industrials are heading with certain transaction volumes shifting a little?
Industrial is a really interesting one because it's been the flavour, I can't even call it flavour of the month, it's been the golden child for, say, the last 5-6 years.
Yeah.
We've seen continuous declines in terms of yield, so it's been far more competitive to get in. But on the flip side of that, we've seen really strong growth in rents. So what you have to remember with industrial is there's only so much industrially zoned land in all states. Victoria is probably the only one where there's only so much, but there's potential for more. So it's a very restricted asset class. You can't just magic some more and build some more if there isn't the land there available to build it. So our need for industrial isn't going away. We talked about the e-commerce part.
Yes.
So where do you think all that kind of movement of goods and stuff, logistics is obviously super important. Our number of businesses continue to grow, and a lot of our small businesses have maybe a small little, you're talking about kind of the small investors, a small industrial unit that they perhaps use, warehousing facilities, some manufacturing facilities as well, but the big end of town, really those big, large distribution type facilities. There's also cold storage. We're eating more fresh food, pharmaceuticals, all needs cold storage. That's all industrial land. And now we've got data centres. Now, data centres, that's going to be a big kind of competition for industrial land across the country. So our requirements will continue to increase for industrial if we like it or not. And self-storage even, like residential homes, people are getting into kind of smaller homes or smaller apartments, but they don't want to throw out their stuff, so they put in storage. It's a real funny story how people just will pay money to store their stuff, leave it there, never look at it. Anyway, another topic.
My dad would be your best friend on that one. He's like, I'm not throwing away anything. I'm not going to use a
hoarder, is he?
Proper hoarder.
But even the older demographic too, if you like wanting them to downsize, they've got some like antique table that's never going to fit into another place, but they can't going to throw it out.
The cabinetry with the china.
And it's going to be like, someone gave me this, whatever, and so it's going to go there and sit. Anyway, another topic. But so industrial, while the transaction volumes have decreased, they still represent about 30% of the market, which is obviously a big chunk of the market, about 31% I think it is. Our deal levels have increased like deal value has increased, so there's less deals done, but they're bigger deals that have been completed.
Do you think there's less deals done because current industrial owners are just holding on to the stock because they know it's gold?
It's the same thing. Like if you sell it, what are you going to do with the money? So unless there's obviously times that people need to sell. People will sell. There will be transactions take place. But at the moment, industrial has kind of slowed a little bit. We've seen the rental growth really taper off because there has been a bit of increase in vacancy. So and also with the interest rate increases that we had seen previously, that kind of yield decline started to really kind of dissipate a little bit. So if you like, it's nearly at a low part of the market. With the next round of interest rate reductions, we expect to see probably a little bit more tightening perhaps coming into industrial. But like if you don't need to sell, like why do you sell? We do see a lot of people, owner occupiers in particular, just like to be master of their own domain, if you like, and just have certainty over what rents could do in the future, and they've purchased their own property. And like the institutions, they like to, once they buy it, they don't tend to sell it, and if they do, they're just kind of swapping it with some other big institution too.
Talking about some industrial markets, what are some industrial markets that you would avoid where you're seeing higher supply and maybe higher vacancy rates? And where would you say are opportunistic regions for industrial at the moment?
That's a real tough question. I think anything that's infill is actually pretty damn attractive.
Yeah.
As we know, there's been a lot of move out, no matter what city you're from. It could be going further south and west in Brisbane or out west in Sydney, and just out in Melbourne. They've got so much land there, flat land.
Out to the west, Truganina.
You stand on the ladder, you can see Adelaide. So it's... I think those infill markets that have like kind of that old daggy industrial that's quite secondary, I think there's opportunity in that, particularly with the construction prices so high. Anything built form, like they often sell at or below kind of replacement value. And also that last mile logistics piece is actually really important. So if you can't always get everything moving around, like delivery from out west or something that's an hour away, you need to have those kind of last mile little hubs within our kind of infill market. So I like the small infill markets, some of the daggy stuff.
We literally just purchased a Brisbane industrial last mile logistics hub, leased out to Mercedes-Benz, 8 kilometres from Brisbane CBD, 6.3% net yields, happy customer.
It's becoming an important trend, like what you're talking about, that extra additional, like, hey, let me just make sure the logistic journey is smoother, easier, storage is quicker. We're very impatient. You know what I mean?
Yeah, that's right.
We're very impatient.
Yeah. Well, we're always trying to get down those kind of delivery times, and even like a lot of the clothing and stuff, you can pick, the 3-hour delivery and stuff. So you can't service that unless you have, those goods nearby. Also with those sort of markets as well, particularly if they're close to the airport, port, those sort of regions, there's potential for much further down the line, redevelopment opportunity back to kind of into a resi use, or because they are logistically or locationally really quite advantageous close to the CBD.
So Vanessa, interest rate shifts was something you spoke about, and now interest rates are all touted towards going into a downward cutting cycle. Now, with this being the case, commercial has always been a cash flow play for many investors. How do you see this really reacting with some of the markets across Australia in, whether it be industrial or other markets, just overall commercial property transactions? What do you see happening there?
I think that just instills a lot of confidence in both buyers and sellers, to be honest. I think that while there is a lot of cash buyers out there, or people like the maybe 50% cash, 50% lending, I think that there will be some possible tightening in yields in a lot of different asset classes. But for the owner's side, there'll be a lot of expectation that there's going to be yield kind of tightening. But the fundamentals still are at play. It still has to be a really good quality asset. It has to have the good kind of rental expectations, the supply, all those sort of things. So I think that what it does is does distill a bit of confidence. And if you look back at those numbers, so $80 billion worth of transactions this year, it's pretty much exactly the same as it was last year. And the year before that, it was a little slightly higher. And during COVID, it was like, we're talking about $130 billion. So we're way down on where we have been in the past. And that's because we've been kind of kicking the can down the road, if you like, to some extent. People have been reluctant to move because they're just waiting and seeing what's going to happen with interest rates, what's going to happen with this, and this might kind of spur on something else. So I think that as we do enter this kind of cutting cycle, that will distill a little bit more confidence, and people will feel a bit more confident to do something, which is always good. And we'll probably see those transaction level increase, and hopefully a bit of yield compression in those really good quality markets.
Well, we're excited to see what's ahead for the industries. I mean, thank you for putting out such great research on commercial transactions, industry segmentation, giving us a clear picture of what to expect and what we've seen occur in Australia. Thank you for joining us on the show, and looking forward to having you again.
Thank you. Thanks so much.
Cheers. Awesome.